Thank you so much, and thank you so much to Coface for this very kind invitation to speak to you all today. I have about 20 minutes or so to run through our thoughts on Asia, a key driver of growth, but I would argue for old time's sake, at least kick off with some other parts of the world, starting with the US and Europe, even though they're not actually the biggest drivers of growth anymore. So not only do I agree fully with everyone's view in here that Asia will likely be the strongest performer amongst those markets that you were given a choice on choosing between, it is also the single largest driver of global growth itself. It is this year, and we think for the next several years, going to account for 60% of global growth. And this is a major sea change from what we would have seen before. But I'll show you some more of evidence to back up some of those points in just one moment. But firstly, I should also stress, I'll run through some of the US thoughts on Asia itself. It's, yes, the best economic neighborhood. In the case of the US, which I'll come on to now, steady growth, I think similar to comments we were hearing earlier. Similar story for Europe, which has plenty of its own pent-up investment demand now being realized. But my final point that I would make is that the key differentiator within Asia from our view is going to come down to who is delivering and who is not delivering on investment spending. So there's many other aspects I'd like to discuss, including, of course, to do with trade, what the patterns we think will be in the coming years. But most important of all will be to do with how prices move, and of course, to do with some of those leverage issues that also have been raised already this morning. So hopefully, if I get a bit of time, I'll run through that as well. So starting with the US. GDP growth has been relatively steady. In fact, we have one of the longest periods of prolonged economic expansion in the US that we've seen in post-World War II economic expansion histories, but it's been relatively slow in terms of the actual pace itself, and that continues to be the case. I think now, whenever, say, in Europe or the US, you see a growth rate that's around 2 or slightly higher, people are relatively happy. And that certainly is the pattern that we think is going to be happening this year as well as next. The fiscal policy drag that you had seen in previous years in both Europe and the US is not there. In fact, let's wait and see just how much you may actually get from some tax-related stimulus to growth that could come through this year if we are able to see progress in Washington, though the track record so far when thinking through other attempts at major legislation is not giving us a huge amount of hope, and certainly none of the numbers that you see here before you assume that there is any major impact from anything that does eventually manage to get passed. One other message that I think is critical when thinking through the US side is one on monetary policy. Our view is that we think the Federal Reserve is likely to be probably finishing its rate hiking cycle next year. Our view is that we reach 2%. We do not think that the Fed's guidance that they'll be heading towards 3 and maybe more is going to necessarily play out. And I think part of that comes down to the amount of slack that we believe is still in the economy. But I'll come on to that in the next slide. One thing I want to mention also is that when it comes to what to expect out of politics, I would watch actions rather than words. So what I mean by that is, for example, if you were watching every single tweet that was being released by the president, you could be a lot more panicked about what could be coming next compared to watching purely, if you'd switched off Twitter, switch off all social media, don't watch the news or the headlines every day, and instead focus on what has actually happened. And actually, it's a much more benign outcome. So when we get asked, why are we not seeing political risk being priced in even more, we would argue that through the last 12 months, since the election of Donald Trump up until today, people or markets have been focusing more on actions rather than words. And certainly there's plenty of things you could panic about, the tensions in North Korea, the original decision and then reversal of the decision on policy towards Taiwan and the One China policy. There have been many areas, but ultimately a steady path has been seen. If that remains the case, then markets should not be panicking so much. But of course, that is on our radar. What is also on our radar on the US side is to do with wage growth. Why is it, as we show you on the left-hand side, that with the U3, U6 measure of the unemployment rate, a measure of broad versus narrow unemployment rates, showing you a degree of labor market tightness, with the labor market so officially tight, why is it that we've not seen even more wage growth? We would argue some of the reasons for it could well be to do with the baby boomers retiring, distorting some of the data. That's possible. It could also be to do with this technological change that's already been discussed earlier, impacting on lower wages, lots of lower paying, less secure jobs being created with lower productivity in those services industries. And also unemployment, maybe underemployment is the way of thinking about it. Is it being measured right? Do we actually have a relatively large amount of slack even still, with a still relatively low participation rate in the United States compared to what we saw before 2010? All of those issues, I would argue, to us, spell that while wages could continue to accelerate a bit in early 2018, given the lag that you see in the relationship, the disappointing disconnect that has suddenly appeared will not fully go away. And so our worries, or certainly I would say the market's most sensitive point of all, which would be if the US were to be on a much more aggressive rate hiking cycle than we think, is unlikely in our view to materialize. It's one to watch, one to keep in mind. Certainly if you see a surge in wages and inflation in the US, you should start to worry a lot more about that risk impacting and forcing a resetting of flows around emerging markets, but it's not our central case. So let's move on to what we think about the euro area. I would say the best way to describe it, while the performance overall remains quite uneven. You look at, for example, the level of Italy's GDP still significantly below the level that it had about a decade ago. Compare that to Germany, the UK, France, that are well above. There's quite a divergent story to be told here, but I think the most interesting one of all will really come down to the fact that credit growth is improving. The underlying fundamentals are actually looking that much better. Money supply growth has been steadily stronger. Loans to both corporates as well as households have been improving, and we've seen interest rates on loans coming down substantially, though some questions remain over just how sustained you will see those drops in credit spreads around Europe after the ECB begins its own tapering program. And the way that we look at it is, while it may not be as disruptive for global markets as the US taper tantrum was, it still will matter for sure within Europe, and may well also matter a lot for the foreign exchange markets if the ECB goes ahead, as we think it will, with a tapering program where it will have finished QE completely by around Q3 of 2018. Meanwhile, retail sales, new car registrations, signs of domestic strength are steady. There's certainly there's no boom going on, but certainly everyone would be delighted with growth at or above 2% in the euro area as a whole, and industrial production is doing quite well. The way that we would look at the key driver behind a lot of this is that after all of these years of being so weak and holding off on investment and worrying about this rise of populism and the problems created since the financial crisis, actually a lot of investment decisions were delayed. If you look at the cumulative volumes of investment, it's still negative cumulatively since 2007. So if we go through all the way from the first half of 2008 all the way to the second half of this year, we believe that we're going to see more of this investment story helping to drive growth. That's good news for Europe. Certainly it's good news for anyone who's exporting or trading in capital goods. But I would argue that's not necessarily something that has a very strong relationship, investment, compared to consumption would have in the West on impacting on the rest of Asia. And if I may, in the interest of time, move on to Asia. I mentioned earlier how Asia is the most important single driver of global growth. Not only will it be growing faster, but it is also 60% of global growth. And that's even with a slower China that we think will come in the coming years. It's all about momentum when we talk about contributions to GDP growth, scale and velocity. So your mass times velocity gives you your momentum. The fact that you're that much bigger, even though you're moving less aggressively, still means your momentum is significant. China is undisputably the largest single growth driver, and it has been true for a decade already. I think more interesting is the second line, the AXJC line. ASEAN plus South Asia combined with a few others thrown in there is what that represents. That as a single economic entity, and we as an institution actually group it as a single business entity for us, the ASA region, ASEAN and South Asia, that is actually the second largest driver of global growth on its own after China. So it's not just because of the scale of China. But of course, within Asia, we know there's many diverging stories to be told. Just take a look on the right-hand side on our GDP forecast, and you'll see that versus the dots, which represent the 10-year averages, actually not that many countries are managing to even match those 10-year averages. Certainly the ones on the far right, the more advanced, slower growing economies are not doing so well, but there are a few exceptions. Eventually, we think after the difficult times that India is going through now, for its own context, it still is one of the top performing growth markets of the region, it will once again go back up towards the 8% growth rate in the coming years. But separate to that, the Philippines and Vietnam are two great examples of economies that are growing faster than their 10-year averages, and there's plenty good reasons for that. The FDI story in Vietnam and the transformation of the exporting industry there is an incredible story to be told for anyone. But on top of that, delivery on investment is going to be the big driver of all. And that is one where I'll come back to it if I get time a bit later. But first, let's look through what the story actually is within the region when we go between the domestic and the external sector. If I may point you to the lower section of this heat map, greens means faster growth than the last 3 years, reds means slower growth, and yellows in between. You can see across the board, the external line, exports, is all green. It's been a good year for trade. But and this is true for so many of the economies in the region that is the most open region to trade in the world. Why has that not translated into better numbers on the domestic front? We would argue that it comes back to that story about leverage. So many markets in the region overstretch themselves in various sectors, which I will show you a little bit later in a similar style heat map, hopefully if I have time. But more interesting than that is the fact that exports, yes, they were doing well, but look at the exports broadness index, the second row there under the external sector. It's a relatively narrow list of countries that actually were driving it. And it's also a relatively narrow list of products that were behind it. Electronics and China were the answers to what was making it so narrow. They were the biggest single drivers. But what else was it behind the improvement in exports? I would argue the other thing that really helped was volume versus value. In 2016, at the early parts of the year, when everyone was so miserable about global trade, we were being, I would argue, dragged down by the fact that prices, particularly of commodities, and with a lag of overall exported goods all around the region, actually ended up dragging down the overall numbers, leading to that miserable growth rates that you see here for Asia as a whole using the WTO data for exports by value in green. But then you look at the flip side, as we did in the early parts of last year, and we said by 2017, you're going to see the opposite. You're going to see some improvements just on the back of some retracement in commodities and a retracement in exported goods prices. And this is what we've been seeing through this year. But a recovery in prices and a base effect, and indeed China's inventory rebuild that I was discussing earlier, these are all temporary factors. This is why things are probably as good as it gets for the export story as of the first half of 2017. And as the arrow on the right-hand side of the right chart shows, we're expecting now to see some easing off of that growth rate. And as a feel for just how important China on its own was for the whole region in boosting the export data, look at the light blue bars on the left-hand side chart. That's the share of export growth represented purely by China. And then we show you, for completeness sake, the US and the EU, relatively, I would say, relatively softer by comparison. So even with the steady growth rates that we've seen, the importance of the swing factor of China will remain pretty critical. Now, you may have noticed I actually love using heat maps. This is another one of my favorite ones when thinking through where monetary conditions are in the region, because this is a key guide when we're thinking about the fact that we have already seen a few rate hikes, some that weren't even priced in for the US this year. We've also seen at the same time other central banks, particularly ones that suffered so much, or their currency suffered so much during the taper tantrum, managed to actually cut policy rates. India and Indonesia are the two ones that I'm thinking of in particular. And why was it they were able to do that? I would say this indicator is our favorite one of all to help explain that. Here I'm showing you monetary conditions for each economy compared to their own 3-year history. Are we loose, which is green, or tight in red? Anywhere that is red is where we have been highlighting the risk of surprise policy easings. And as we go into next year, thinking about where could be considering hiking rates, focus on the patches of green. This has been, of all the indicators we like to use, one of the most useful ones that we get the most requests on. So I just thought it was worth a quick mention for you. But in the interest of time, I will keep moving through. Firstly, to show you on infrastructure, those who have or have not been delivering on investment and on trying to drive up infrastructure, that has been one of the big divergent themes that we've seen around the region. I would argue Indonesia and Thailand, while they're doing okay, they could be doing a lot better on delivering on infrastructure. We think Thailand is probably where you will see the next big surge. Should be coming over the next 18 months, maybe 2 years, depending on how the elections go as well over there. And that could mean that we see finally those mega projects that we've been waiting for so many years materializing. But take a look at the Philippines figures. This is one where even before the extra drive that comes from the Duterte administration for more investment came in, we already saw a surge in investment spending there. And that's where I think the big story will be a big positive. Another one, of course, will be to do with tourism around the whole region. Thailand already having done quite well. I would argue again that the Philippines is a location that now that its political relationship with China is improved, why will we not see even more tourists going to the beaches of the Philippines and not just going to Thailand, where 45% of tourists these days are coming in from mainland China? But I promised I would try and get to, and I did, over to, I'll try and make one of my last slides of today. It's been a bit of a bombardment from my side. This is on where those leverage risks that we've been talking about really lie all around the region. And while the most obvious one of all is the one that we've been highlighting for the last 4 or 5 years already, i.e. China, and particularly the corporate sector and the large over-indebted state-owned enterprises, there's plenty other patches that have been dragging down on growth around the region. I would point to the debt service ratio in the household sector in Malaysia, which is actually more of an issue than in Korea, which is a lot more famous for having been muddling through in the household sector with a overburdened part of the economy for many, many years. Thailand also was in that category of having relatively overburdened household sector. But interestingly, take a look at where the places are that could be sources of strength. And I'm thinking about where you could see consumer demand coming from. If there's even more ability to give financing, maybe using new technology companies. It's an exciting story at the moment, for example, in China and in Indonesia and India, on seeing new startups that are able to expand credit to parts of the household sector that were once not getting access. That comes with its own risks and regulatory issues too, but look at the green, patches of green in the 3 largest economies in the region. China, India, and Indonesia all have patches of green still, and their ability to drive growth and keep it strong through using more credit in consumer spending, i.e. more consumer goods being bought, more tourism, more purchases of services in that sector, that is a key source of strength that I would focus on, not just on where the patches of red and the risk factors really lie. So I will conclude with one final thought, which is while all of those issues are the other one big challenge, separate to technology, the biggest single drag that is coming for growth in this region, even after all these happy things I've been discussing, is the demographic drag, the rapid aging all around the region. And to show you that in what it means for GDP, just based on projections for working age populations on the right-hand side, we have the historical and all the way out to 2030 numbers with Japan for context of who will go from seeing a GDP contribution that's significantly positive just from more people showing up to work every year, all the way down to being a major drag on GDP growth, and it becomes acutely, I'd say, large and significant through the 2020s. That includes Thailand, but others in ASEAN will still be able to do okay. For example, the Philippines and India are in a relatively good position. But those who can help drive up the quality of the labor force, drive the education, be able to adjust to new technologies and retrain will be in much stronger positions alongside those who can deliver, as I mentioned, on those infrastructure projects. And there certainly is plenty more that can be done to drive up the productivity and income alongside urbanization. Those are reasons why, even in the next few years, continue to expect Asia to be that best economic neighborhood, but these huge challenges on the infrastructure side and on the demographic drags cannot be ignored. So I will pause there and looking forward to the panel session, and thank you very much for your attention. Thank you.